What's up? I'm Dan Fredenberg, and this is another chance encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house. It's going to be torn down soon. I understand that there are power lines that are getting kind of close.
What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. Hey there, my 9-year-old daughter has a reminder for you using this paper katana, and that is to make sure you hit the gear and use the speed controls, because it changes it from this, ready, into this. Like magic. I'm joined today with Zane, and it's Schartz, right? Is it Schartz? Is that how you pronounce it?
Zane Schartz nailed it.
Excellent. And how are you doing today, Zane?
I'm good, ready to roll, ready to chat about life in real estate.
Sounds good to me. And I got some great news about this too, Zane. I don't know if you're aware, but today we are actually joined by my very favorite member of the audience. And why is my favorite audience member here? Well, clearly it's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors, passive investors, operators, buyers, sellers, all that kind of stuff. You might ask yourself, why would you do something like that? And the answer is, if you've ever heard of private off-market deals, these are the ones that you're not allowed to publicly discuss, then you should know that you need documentation of your prior substantive relationship, or else the SEC will get ants in its pants and you might lose your business in the form of rescission. That's bad. So I have people on here. We talk about what's your buy box, what's your motivation for being involved in all these deals and all that kind of fun stuff. And the major benefit to you is that you'll learn to more effectively communicate on the subject of commercial real estate deals. But before we get too excited about real estate, Zane, do you want to introduce yourself a little bit?
Sure. Zane Schartz, President of Freedom Commercial Real Estate, based out of Dallas, Texas. We run funds of single tenant net lease properties across the country where we buy investment grade tenants, basically the best tenants like Starbucks, AutoZone, Dollar General, et cetera. And we currently manage 200 plus million dollars of assets, 70 plus properties across 20 different states, and 450 plus investors. So we're very big on cash flow. We're very big on capital preservation, and we're very big on consistency and stability.
I love that answer. And the first segment that I always go through is the 5 distinct motivations. Before that, I got to say, but wait, check your eight. Zane, you seem like you're on the younger side, so you probably have good technical acumen. I was wondering if you can try to look through the camera and down into the user's device, because down there might be this big, ugly subscribe button that they really should
Oh,
do something about. Yeah, it's a stupid
I
joke.
see it. I think, I do see it. You should probably subscribe.
Exactly. It's a good idea. It's free, right? Anyway, the 5 distinct motivations. I've now literally interviewed hundreds of different players in this space. We're pushing 500 these days, and everybody has their own unique reason why they are doing these deals. And even though it is unique, I find they fit pretty neatly into these 5 motivations. Now, the reason why real estate people need to know what the motivation is because when the going gets tough, is going to be pretty tempting to throw in the towel, and so we need to know it's what's going to keep going, keep somebody motivated year after year to stay in the business. And the first motivation of them is preservation of purchasing power. What's that? Some people, they are either earning far more than they're not living hand to mouth, so they have investment dollars coming in every year, and they need to make sure that that nest egg keeps on accumulating instead of being eaten away in the form of inflation. Other people are completely work optional. They already have a portfolio of assets, and the times that these people are going to be motivated enough to make their next acquisition is either when inflation is eating away at the purchasing power of their cash flow, so they need to make another acquisition, or if they're getting the steepest discount possible. Now, of course, everybody should try to negotiate the steepest discount when you're making an acquisition as possible. But the emphasis here is people in this situation, they're not going to pull the trigger unless they've got that sort of advantage. And full disclosure, I'm not at this phase of my real estate career yet. What describes me better is trading time directly for wealth. And what I mean by that is I've got a background in technology. That means I was a high wage earner, high salary earner through the tech side, especially through CRM and building full stack developer, being responsible for the tech stack and the staff. And so as I started working for a real estate company that was flipping 10 houses, doing 10 different single family transactions per month, I got to thinking, hey, wait a second, I seem to be on the wrong side of the right business. And so instead of trying to build my tax bill by having a bigger salary, it hit me, I should try to focus on being compensated in the form of deployed capital, aka equity. So that's what I'm up to. I get that that's subtle for some people, especially youngsters, where they are more likely to want to hustle like crazy right now so that they can fast track their retirement. Other people who maybe they aren't so young, maybe they just want to control their schedule a little bit more so that they can go to their kids' baseball games and that sort of thing without being accountable to a boss or something like that. And that is a fantastic reason and motivation for doing your acquisitions. The only downside I find is a lot of people who are trying to fast track their retirement, they think that secretly everybody is trying to hide the fact that they're trying to fast track their retirement. And I assure you that's simply not the case. And then in this industry, there's some people who are fueled by ambition. They want to buy their entire hometown. They want that generational wealth to make sure that their great grandchildren never have to hold a day job. That's great because they're going to be hustling into their 90s, and these deals really need somebody who's not going to be asleep at the wheel, someone who's really motivated day in and day out to be involved and make the lives of residents, if you're talking multifamily or just people who are leasing, also the investors themselves keeping tabs on the operations and all that sort of stuff. And the other group that is going to be hustling into their 90s is not so much for their own generational wealth, their own legacy. Maybe they picked a sector of society or the environment, or maybe it's animals. Who knows, but they figured out that there's a financial component to really making a big impact. And so that's why they're making their commercial acquisitions. So Zane, I know that you were saying that you focus a lot on retail properties. I'm not sure if it's like triple net or whatever, but as far as these 5 different motivations, what combination of them sounds more like you?
I'd say for me, it's probably the fast track to retirement. I think that's what a lot of my investors want too. Investors that we work with are looking for financial freedom and time freedom, and we provide that through cash flow. And yeah, so everything we do is triple net leased, and the properties we own are backed by triple net leases of the biggest companies in America. So, fast track to retirement is probably what most people are trying to do. Everybody wants financial freedom. Everybody wants more time doing the things they love and pursuing their passions. So, we offer that through very high credit, low risk investments.
I love your candor on that. That's fantastic. That brings me to the next segment, though, which is the tolerance for risk assessment. If you've ever been involved in one of these private off-market deals that I was talking about, the ones that are not publicly advertised, then you should have had a securities attorney in the mix of the offering, and they should have required that everybody fills out this super invasive suitability questionnaire. It's a financial questionnaire, all sorts of questions about like what's your net worth, what's your investment history, how comfortable are you with risk, those sorts of things. But when I was filling out my first one of these questionnaires to get the pitch deck and all that kind of fun stuff, I found that the tolerance for risk question, it was a bit problematic. It lacked utility. I felt that it didn't matter which one of the multiple choice answers you chose. You couldn't really take it to the bank. You couldn't really be sure that their tolerance for risk is what you perceived. So for this interview, I made my own one, and it's a fill in the blanks question. It is, there are many popular investment asset classes, but I think blank is too risky. So Zane, it can be inside real estate, it can be outside real estate. You could have one of each if you want. What's too risky for you?
I am going to stay within real estate, and I'm going to say value add multifamily. I think there was a lot of money to be made in value add multifamily, and I think there still is money to be made in it, but I think it is much more risky than investors understand. There are so many variables that go into value add multifamily, and if you're with an unexperienced operator, there you need to hit everything essentially for you to make the money that they project. So I think there's just a lot of risk in the amount of variables in that. So if you're taking a property from a C class, trying to put in five or $10,000 a unit and take it to a B class and increase rents and cap rate compression, there's just a lot that goes into it um, that I think is riskier than investors that believe and understand. And that's basically what we tried to do is create the antithesis or opposite of that and create something that was so stable, very few risk, as few variables as possible to kind of create stability and consistency through cash flow. So that's what I would say.
I absolutely love that answer, and it's no secret. The vast majority of guests on this show are multifamily, and so it's a breath of fresh air hearing you describe it that way. Because quite frankly, I think that a lot of the owners, they know what they got, and they know that they're in a bit of a dip in the cycle. So the thing is, they know that they're probably better off just like, even if they're hemorrhaging cash, just holding on to it and taking these additional risks instead of selling it at a price that can pencil. So that's why I'm really happy that you're that frank about it. But let's move on to favorite deal metrics. Of course, it's going to be a little bit simpler for Zane because of his business model. And full disclosure, the first couple hundred chance encounters, I didn't include this slide, even though I really, really wanted to, because I felt it was a little bit fastball for some people in the real estate community. Maybe that's because they have a lack of experience, or maybe because they're PR or marketing people. So they're not really spreadsheet jockeys. They're not the people who do deep dives into financials and underwrite the deals. And so it's kind of a mean thing to put them on the spot and ask this. But no matter what, we are curators of deals. You have to understand some deal metrics. And so on this show, for everybody who is just listening and not watching, I read out these 14 different metrics to jog people's memories, really. And here we go. The first one is cash on cash. Second one is IRR, which is internal rate of return. That's talking about your equity multiple. In other words, you invest 100K, what are you looking to wind up with as a multiple of that? Then there's the cost per door. There's the net operating income. There's the going in cap rate. Basically, if you're talking about commercial properties, it's going to be published through brokerages what the going cap rate is in any given area. And so it's a really fast back of the envelope way to know what kind of discount you're getting. The next one is the loan interest rate, which is especially important if you're going to be assuming a loan. There's the occupancy rate, which is the inverse of the vacancy rate. So it's the same number, just inverted. So don't get confused on that one. Then there's the average income where the property is located. There's the amortization period of the loan. Again, that's especially important if you're going to be assuming a loan, seller financing, that sort of thing. Then there's the difference between the market versus the in-place rents. Zane was mentioning the value add element, so that's where that one comes in particularly strongly. Then there's population growth in the location where the property is. That gives an idea of the additional demand in the area. Then there's the sponsor record, which is how many deals have already gone full cycle, how many deals are on the go right now, especially if there is a value add component. Then there's the waterfall split or exit strategy, which is about what is going to happen to your investment after your capital has been returned, your principal has been returned. And then they have DSCR, which is debt service coverage ratio, which is talking about how much of the revenue from rents and amenities is going out the door immediately just to pay for the loan. So Zane, again, this isn't an exhaustive list, but do you want to give like a top three or something as far as what you tend to focus on?
No, I'll pick my top two. Cash on cash is definitely number one. We're a very cash flow heavy investment, and that's what all of our investors are looking for. They're looking for cash flow, and we provide it. We do monthly distributions every single month, so investors get direct deposits and are able to use that money to pay car bills, mortgages, phone bills, like bills that need to be paid every month. And that's why I'm a big believer in cash flow because a lot of people push for heavy appreciation plays where you may not see a return for 3, 4 years, but you got bills over those 3 to 4 years and you need cash flow to cover them. So we're very cash flow driven. And the second one is probably the sponsor record. I think having a track record builds two things. It builds trust with investors, and two, it builds relationships across the industry. So those relationships can be leveraged for, getting the best properties, getting the best loans, knowing the best tenants and knowing how to be a better operator, which in turn, investors reap the benefits of that. So I think there's also a lot of sponsors and operators out there that have no idea what they're doing. I'm going to call them out. I'm not going to say any names because I'm not going to be that pointed. But there's just a lot of people who don't know what they're doing, and they're good at raising money and pitching a story, and maybe over exaggerating on returns, and people trust them. But there's just a lot of wolves in sheep's clothing out there, and it's very sad actually, and they lose a lot of people a lot of money. So I'd say, like, as an investor, just doing your due diligence, making sure that you're investing with somebody who's trustworthy and who you just get a good gut feeling about, I think is really important. So we have a good track record. We have a lot of referrals from our current investors, and over 50% of our active investors have reinvested with us. So we have a very high reinvest rate, which we're very proud of. That means that we've done something right and they want to come back for more. So those are kind of the two things I would say we focus on.
Absolutely love that answer. Yeah, it really resonates with me. And like the other thing that hit me as you were saying is there's also coaching programs out there, which it seems like they're not actually doing the deals. It's more like they're a marketing company that happens to do coaching rather than a real estate company that has a coaching wing. So that's fantastic. I'm gobbling up that answer like a delicious subscribe sandwich. It's a very subtle way to say it's time to move on to the Dan Does Deals Commercial Core Competency Cube with the 6 different roles in a commercial real estate deal. It is a little bit focused on multifamily or those sorts of commercial properties, but it'll still apply. But the idea is I go through all 6 sides in every episode because that will help you more effectively communicate on the subject of commercial real estate deals and understand how my guest fits into those. And if you're watching me go through these and saying, hey, I need to get me one of those cubes so I can explain it to my friends, my family, all that sort of thing. The good news, it's absolutely free. You can go to dandoesdeals.com and there's this big conspicuous button that you can click on. It goes straight to the PDF. You can print it out and show all of them. So the first role that we need to discuss though is the repositioner role. The repositioner role is an acquisitions person. They are going to be doing a lot of paperwork, a lot of underwriting, looking at a lot of different properties, and they're looking for upside. So the biggest thing is they have to find out, first of all, is the property actually making the amount of money that the broker/seller claims it is? Because some people like to fudge numbers, and you need to be able to see through all of that and find out what is the deal that actually has this tremendous upside. But if I were to think of one thing that's most confusing about repositioners as far as like what are they up to, I'd say it's the fact that they have to have a big circle of financiers. So that's passive investors, that's bankers, lenders, all that sort of thing. And these people, these financiers, they only deal with the owners, the paperwork, and money. So they are not getting involved in unclogging toilets or any sort of operations whatsoever. That's what they're up to. The reason why every repositioner needs to know lots of them is because if you can find cheaper money, that goes straight to the profitability of the property. So that's what that's all about. But the next place the repositioner frequently looks in commercial property acquisitions is they're going to look at operations to see where those Benjamins are going down the toilet. Now, of course, there's more to operations than unclogging toilets and mowing lawns and collecting rents. Me personally, when I put on my GP hat on GP teams, I tend to add both the tech stack help with automation and all the CRM based functions that I have worked in over the years. But also, you have to understand that in real estate, vacancy is the enemy. It is the deal killer. And so even if you're looking at bigger multifamily properties where you've got a third party manager, the fact is if they can't fill the vacant units, then somebody on the GP team has to have some serious marketing chops, step in and get those units filled, and that's where I throw my hat into the ring. But of course, there's only so much you can do in terms of operations, so the next place that the repositioner often looks is they get a contractor team involved to do a value add, as Zane was mentioning earlier. In other words, you renovate the place so it's nicer, so the future residents or leasees, they'll be willing to pay more than the previous one. But if only things were that simple. The fact is you can spend endless amounts of money upgrading a place. You can gold plate the toilets if that's your thing, but you're not going to get a decent return on investment. And that's not the only danger spot. See, the fact is maybe they're using subpar materials. Maybe they're dragging their heels and not hitting the schedules, the different deadline dates. And if you're like me, see, I don't know if you know this about me or not, but I'm from the internet. So that means I need locals. I need boots on the ground, somebody who can be there in an hour or two, because categorically, that's not going to be me. I'd still be stuck at an airport in an hour or two. So I need to have somebody nearby who can keep an eye on the construction team, the upgrades, also keep an eye on the operations, especially if it's a third party service that is taking care of it. And then they can report back to the GP team, and we know that we're in good shape. But for the sixth and final role in these commercial deals, I like to use a little bit of a hypothetical. Let's say you're an attorney or a physician, a surgeon, an engineer, something like that. Maybe you already have a couple of single family rentals or an Airbnb or something like that. So you think to yourself, hey, I know how this works. If I want to take over a big property, I come up with the down payment, I show up to the bank, and I buy it that way. But when you are talking about a commercial property, let's say you're talking about a 350 unit apartment complex down the street, you might be thinking, okay, well, if I turn around to the hospital or basically at work and I hit up my colleagues, I say, hey, let's all pool 100K each or something and take over that huge building. And then full of confidence, you turn around to the banks, the financiers, you say, I want to buy that great big building over there for tens of millions of dollars. You don't happen to have, say, tens of millions of dollars you want to lend us, do you? Well, that is where this next step is going to come involved. And if you're in a mentorship program or you have a guru or something like that, I encourage you to listen especially carefully to this next part. The bankers are going to say, who's your KP? Who's your sponsor? What's that all about? See, lenders are in the job of preserving capital, making sure they don't lose money. One of the ways that they do that is they do not call you eligible for a commercial loan unless somebody in the fold already owns a similar asset. In other words, if nobody on your GP team has a 350 unit apartment complex already, then there is no 350 unit apartment complex in your future using a commercial loan. So that person is called the sponsor or KP. Now, on top of that, you need a certain amount of liquidity to prove you can actually run the place. And then among the GP team, you need the collateral or a balance sheet of at least the amount of the loan. But if you have all those pieces, you've got a traditional commercial real estate deal. Now, of course, Zane, you mentioned the triple net aspect of what you do. And so it's not anywhere near that complicated as far as the full team. But so for the virtual assistants and whatnot in the audience, do you want to say where you fit in as far as those roles?
I'd say really the big thing that we offer and our biggest differentiator is operations, but I'm not going to say operations from like a property standpoint. I'm going to say operations from a portfolio management standpoint and how we add value to investors. So as a operator, what we look to do is increase the value of each property within our fund. So we do that through lease extensions, through the tenant relationships that we have. We do it through making sure that our properties are taken care of very well. We do it through broker relationships and getting off-market deals that maybe we get below market, and then we can flip them and do a blend and extend for a higher valuation, or we can have a easy exit for a buyer on the back end. So from an operations standpoint, less of the day-to-day of fixing toilets and multifamily painting walls and exteriors and fixing parking lots. It's more of operations from a portfolio management side, and that's the value that we add is our experience and our team in place, our lender relationships, our broker relationships, and our tenant relationships is really what creates value for investors.
All right, excellent. And then we can get into the specifics. Saying you're in real estate doesn't really say a whole lot. And so in real estate, people are saying, hey, what's your buy box? What are you looking for? What's an ideal property? We're asking about three main things. The first one's geography. Where is it? Which states? Which counties, possibly even which neighborhood. It's all definitely going to matter. The second one's going to be size. Now, when you're talking about multifamily, for example, they tend to measure size by the number of apartment units. We call it unit count. The reason why it's relevant is because the type of company that takes over 5 or 10 or 15 unit apartment complexes, they're going to be fundamentally different from the ones that are taking over 100, 150, 350 unit apartment complexes. So the size matters. Now, of course, the other types of commercial real estate, they don't necessarily go off a unit count. They might go off of square footage. They might go off of acreage, like industrial or warehousing and that sort of thing. But that element of size is still going to be relevant regardless. The third one, though, is commonly called class. I'm not a fan of that term because it makes it sound like it's only one thing and it's two. I prefer the term desirability. And the desirability is split into two parts. The first one here is the area, and then the second one is the condition. I'll talk about the condition, which is we're talking about the amenities that are involved, how recently it was built, how recently it was renovated, that sort of thing. When you're talking about the area, the crime rate is always going to be important. But if it's residential, then the school districts are going to be relevant. But when a broker says location, 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 they really mean traffic, traffic, traffic. How many people are passing by that property every day? Because that increases the desirability. Now, the desirability is rated it's the same way as in grade school, where you got A plus at the top, then A minus, then B plus. So Zane, it sounds like you're more on the A side. What's the sweet spot as far as locations and those other factors as well?
Yeah, so I think you nailed it on the head. Like, first off, we look for A class properties, institutional grade assets from day one, and then traffic counts are really important. We like hard corners. There's a lot of repurposability. So the stuff we buy, um, you know, they're all just four-walled boxes, and they can be repurposed for a lot of things. So on our acquisition side, we're looking for where's the closest competition? What could this be if it's not a Starbucks? What could this be if it's not a CVS? So repurposability is a big thing. Traffic counts really go into that. Rent per square foot is really important. Comps in the area are important. So we're looking at a lot of different things. Median household income, which you mentioned earlier. There's so much you can look into in a real estate acquisition, and those are just some of the big ones. So traffic counts, median income, economic drivers in an area, population growth, et cetera.
Perfect. And so that brings us to how to reach out. I'm going to sandbag that for a second. It's the biggest thing for me. I've got a really distinct last name. That really helps people find me on LinkedIn. That's where I spend most of my social media time. So that's where I encourage you to connect. The QR code, just so you know, that it goes to my Amazon author page. I got a few different books on different skill building, business related books and that sort of thing. So you can check that out. And Dan Does Deals has the rest of these interviews. If you want to appear on this show, that is the way to connect, is through LinkedIn, to DM me that way. But Zane, if people want to reach out to you, what are the best ways?
So the best ways, there's three ways. First one is just email directly. My direct email address is zane@freedomcre.net. You can also visit our website, freedomcre.net, or you can add me on LinkedIn. So I post a lot on LinkedIn, Zane Schartz, and I post a lot about what we do, how we do it, why we do it. I try to put a lot of educational stuff out there into kind of what we look for, why we liked a property, why we didn't like a property, what we liked on an underwriting of an asset. Really just trying to educate people, and a lot of investors have seen that and have liked it. So those are probably the best three ways.
Perfect. And that brings me to my public service announcement for you, not for you, Zane. It is, if you've been watching this episode and experiencing searing pains in your eyeballs, maybe like migraine-like symptoms, I'm confident it's due to the downright hideous subscribe button that maybe you haven't hit. Now, of course, if you have any youngsters in the house, they're going to judge you for not hitting it. So it's a good idea. As far as what it actually means, it just means that my videos may show up on your list of suggestions. I want people to click it so those deadbeats at YouTube start to pay for these videos instead of me. Wouldn't that be nice? But of course, you can go ahead and ignore those video suggestions. I just appreciate the fact that you came here today. Just like Zane, I appreciate you joining me. It's been fantastic.
Yeah. Thanks for having me. Really fun. Loved hearing about what you do, and it sounds like you got a great thing going. So I appreciate it a lot.
Perfect. Thanks.
You want to underwrite something, and there are people charging anywhere from $5,000 to $5,000 to underwrite something for you, and I just don't see that that's fair. I think our goal is to demystify, or however you want to put it, the underwriting process. Is it smoke and mirrors? Is it that simple? In most cases it is, but I think people are just making it way too complicated, and my offer is you bring something to me, we'll underwrite it, no fee. Maybe we'll get some views, maybe you'll find people who are interested in what you're looking at and take it from there. I think our goal is to show people that they can do it themselves, to show them that it's pretty straightforward and easy to do. Some people like to be more conservative. Some people like to be a little more, free spirit is kind of the way to put it. To go out there and make some money, you're risking money. And, that's kind of the goal here. The goal here is to kind of give you the basics so you can go into that next phase. The whole goal would be to create a spreadsheet basically of what your risk tolerance is, and find something that fits your mold. Instead of underwriting 100 deals, find the deals that make sense to you. Do you want cash flow? Do you want appreciation? Do you want equity? That's all stuff that we'll go through. And I think it'll provide an immense amount of value for people to look at their next possible investment. We made sure that, what you're looking at is viable and profitable, because those are the two major factors when you get into this. When it's brick and mortar and you have assets, it leads you down one path. When you're looking at a strictly online business that may have intellectual property or something to that effect, you have to kind of look in that direction as well. So each bucket is going to have its own little nuances. No catch, just knowledge. I think you're going to get a lot of value from this, and just to show you that it's not something you have to pay for. There's no point in wasting time, money, and energy into something that's not going to be fruitful. When you look at these billion-dollar deals that I've looked at versus the $100,000 deals that I work with, the only difference is capital. There's really not much different to it. I mean, there might be more points on this end, or there might be, some hidden asset on this end, but it doesn't make a difference. It all comes down to capital and how you can make money. We're going to have a lot of fun, and we're going to get into the numbers. We're going to look at why this business is profitable and what we plan on doing. There's no reason to beat around the bush. There's no reason to mail it out, wait 2 weeks for a bad example. We're going to go through it pretty easy, 10, 15 minutes, and you're going to get an answer. You're not going to have to wait. You're not going to have to look deep inside anything. The truth is, it's basic. Bring a franchise, bring a friend, bring a building. I mean, we can underwrite a horse race if you want. We can underwrite just about anything to make sure that there's value in it. We can figure out the Pokemon and Jordans, but a lot of that's just going to kind of be researching eBay.
And what sort of businesses can we underwrite in these sessions?
Bring anything. I mean, we can underwrite a garbage company. We can underwrite. Do it again.
Sure. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506B.me or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye.